One of the many benefits of being a Mott's Wealth Management client is the opportunity to speak and meet with industry specialists and professionals. Our speaker for the halftime report is Melissa Mott's, president of Mott's Wealth Management. She has over 25 years' experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on August 14th, 2013. If you're interested in introducing us to someone and they can't make it here, I'm open to do a lunch or dinner, just something informal. So just let us know. And we want to thank our sponsor who's not here tonight, so he's the one buying all the drinks. Marshall Birkins from Franklin Square Investments. So that's something many of us have in our portfolios. So, okay. So I've been learning to play the flute, and I tried to do a little intro for us here with a 20th Century Fox. So just let me know how you like it. Not bad, huh?
Stick with accounting. I give you an A for nerve.
Oh, thank you. Thank you. Tough crowd. Okay. All right. All right. All right. Now down to a little bit more serious business here. We're just going to go over a few words we've learned in 2013. So one is tapering. Okay, so you can holler it out. There are no prizes for this. So we're going to have 3 multiple choice answers. Does it mean taping 2 pieces of paper together? Changing the width of your pants?
C.
Or very good. The Federal Reserve is lowering the amount of assets they buy. Okay, so yeah, that's a new word we've heard recently. Yeah. And it means a gradual, actually. It's not like a cut it off. It's a gradual kind of thing. All right. The Great Rotation. Does the phrase mean the planets are realigning? The Chicago Blackhawks hockey play? Or the theory that will be a massive flow of money out of bonds and into equities? C.
It has to do with crops.
Yeah. So, yeah, C. So massive flow of money out of bonds into equities. So supposedly it's going to be happening. Don't know. And we'll talk about that. And sequestration. Everybody knows what that one means, right? Method used to make orange juice. Ryan Seacrest.
I guess so.
Or large cuts in government spending. That's the one. Okay. We know all about that. That started at the beginning of the year. So the most popular word on tabloid covers in the last year. Shocking, wedding, or baby. Baby. Yep, there we go. The royal baby. The royal baby, yeah. And then there was the other one, we were just talking about that today. Kim Kardashian's baby, yeah. Northwest. Yeah. What an interesting name. Northwest, yeah. His last name is West. So they named him North and, yeah, Northwest. Could be. All right, so we're going to look at what's happened up through, this goes through about the middle of the year, and then up through about June and now, and then the future. So where we've been. So performance this was through June 30th. Okay, so S&P was up 12.6%, stock index. Global foreign stocks were down 1.1. 10-year Treasury yield was up 2.49%. Now, what that means is bond prices went down. When the yield goes up, the prices go down. So I did it up through today. So U.S. Treasuries are down 6% for the year. Municipal bonds are down over 7% this year. U.S. corporate bonds down over 8% this year. So just to keep things in perspective, and gold down 28%. Right? Yeah. Yeah. So we hear the news about the stocks, and they're doing great, but there are a lot of other things that aren't. And typically most people have investments in many different things, not just in the S&P 500. I didn't go over emerging markets were down too this year. So, okay, so we have some expert opinions from the beginning of the year. And this is Bill Miller. He's with Legg Mason. He's a bond guru, and he said that the great bond bear market has begun. So, and actually that was predicted in 2011 and 2012 also. So we're going to see whether it's really happening or not. And then Bill Gross is another fund manager. A lot of people that have 401ks that have PIMCO, Total Return Fund. He's the lead manager in that. I mean, they manage tons of money in bonds. And he was predicting that this year would be lousy for everything. Okay, which isn't really true because the U.S. stock market has gone up. Okay, and then Carl Case, this was from an article in the New York Times from Wesley College, said there are a lot of reasons to be optimistic, but cautiously so. So it depends on what you're talking about. Because the more risk assets did well, I would say this year. Okay, so we have another, we have a couple experts here. But these gentlemen are a couple of fourth graders, and SIFMA has a contest for children to, invest money like in the pretend accounts. So these are two of the winners of the contest that they had.
Stock market is really unpredictable.
Yeah, we learned how to read stock tickers.
And we also learned PE ratio.
Yeah, PE ratio.
And you guys started the third grade with $100,000, and by the time you were done with the school year, how much money did you have?
$150,000.
$150,000. That means you got a 50% return. How did you do it?
We invested in Apple and Macy's. Apple was our best stock, and Macy's was our second one.
Also, we got some bonds and mutual funds from Vanguard and Goldman Sachs.
Your biggest holding was Apple. Why did you pick Apple?
Apple has great products like the iPhone and iPads.
So since the iPhone 5 came out just a couple of weeks ago, Apple stock hasn't been doing so well. What do you guys think? Is it still a good investment?
Good investment only if you invested in a few years, like last year, because when we ended it was like $687 per share.
What's your best investing advice for your parents or your friends?
First, you have to see how it's history, and the second,
you can look at the graph.
Yeah, and then second is what it makes and what is important of what it makes.
If you guys made $50,000 in real life, what would you do with it?
With the money, I don't really know what to do with $50,000.
That's a lot.
Yeah.
Would you save it for college or go on vacation or buy something?
Maybe just for college.
Yeah, because college is really expensive.
So yeah, gosh, if only it was that easy. Because unfortunately, Apple's down like 20% from, in the last year. So yeah, it's a good thing they got out. They cashed out at the end of the school year. So there we go. Stocks have rallied to fresh all-time highs. They've gone. This was up through the end of June. So we hit highs in May, and then they came down. Especially after Bernanke spoke in June. We'll talk a little bit about that. But then they've come back to new highs, but now we've, come back off them. We'll talk about the fact here, best first half for stocks since 1999. Okay? And 99 was a good year. 98 was a little volatile. And then we know what happened in 2000. We started a bear market. So, there are concerns that, oh my gosh, is this rally sustainable? Is it going to, end in the same way the one in 99 did, or is it going to keep going? But historically speaking, so when you look at averages, the history, it's unwise to sell at all-time highs. Average rally following all-time high is 28%. So if we go back farther in time to the 80s and 90s, when we were in the last great bull market of the stock market, we were hitting all-time high, another all-time high, another all-time high, another all-time high, but it was such a long time ago, a lot of us, don't remember that. So here we have the economic recovery is the balloon, and we have the sandbags or the government. So, no pun intended there. It's not political. It goes for both parties. So, yeah. So, government austerity. I think this is an interesting slide. So, government spending cuts are a drag on economic growth. They went into effect this year, but they don't go into effect like all of them. The 10% cuts don't happen January 2nd. They're phased in over the year, and we're seeing more of them are coming about into this quarter and into next quarter. So we haven't seen the full effects of them, and the U.S. tax increase, is estimated to reduce our gross domestic product by nearly 2% this year. So you can see, comparing to the Eurozone, we think of the Eurozone, that they're the ones with all the austerity. The U.S. is actually worse. We have more austerity going on here now because of the tax increases and because of the budget cuts. So despite the higher taxes, the consumer confidence continues to spend more and gain confidence. So we're seeing that in the retail sector, we're just seeing those young men, Macy's. So we see retail sales are just going up, up, up. And consumer confidence, this was up through May, is at 5-year highs. So 5 years ago would have been 2008.
Melissa?
Yes?
The retail sales, does that include internet sales as well?
Oh, I think so. I believe so, yeah.
You would think so.
Yeah, I believe so. Yeah, I don't know for sure, but I believe so. Yeah. So wage growth is stubbornly low, though. I was looking at the numbers that came out last month, and so the hours, average hours worked went down an hour, and the money made per hour went down like a penny. So you want to see, the growth go up because we are a consumer-based economy predominantly. So people have to be having increases, making money to be able to spend it in the economy and keep things moving. So wage growth has mostly remained below 2% since 2009, and consumers are continuing to deleverage. This is the job growth. It's below 2%. So we were having higher job growth. Now we have a low job growth. And then this is the deleveraging. So what deleveraging means is their debt is going down. Okay? So it means they are owing less money. It's going down, down. And what this graph shows, I know it's kind of small, but it's showing the brownish gold bar is mortgages. Okay? And then the purple is home equity revolving, like lines of credit and so forth. The green are auto loans. The blue are credit cards. And the red are student loans. So when you look at this, what you see is mortgages are going down, percentage of mortgages. And some of that is just because they were written off, too. They were declared. Yeah?
What's along the x-axis? I can't read those.
Oh, down here, this goes from 2003, quarter one, to 2003, all the way up to the end of 2012, into the first quarter of 2013. So what we're seeing is overall debt is decreasing. But then also what we're seeing is credit card debt, like that blue line, is becoming smaller. So that's going down. And mortgage debt is going down. But student loan debt is going up. Okay, so it depends. It depends if you're young, your debt's going up. But for those of us that remember what it was like to be young, our debt was higher, typically, when we were young. So.
But it looks as if the big change is in mortgage debt. Is that the case?
That is a big yes.
The rest of them seem, at least from back here, to be a bit more stable. As if that's not changing a lot.
Yeah, it's the mortgage debt is definitely the biggest difference. And, anybody that's tried to get a mortgage in the last few years would know that it's much more difficult to get a mortgage now than it was. Much more difficult. And what makes it even harder is when you have high student loan debt and you try to get a mortgage, because they look at all of that, look at how much debt you have. So it becomes particularly difficult for young people. But it's a good sign, it's a good sign. People are deleveraging, they're getting their debt paid off, and yeah. So where are the jobs? So job growth in general for this time, after we had a big down, we should be much farther along, much bigger gains in job growth by this time, which we aren't seeing. Unemployment rate is stubbornly high. So this is interesting. Labor force participation. So there's 316 million total U.S. population, and the private sector labor force is 104 million. So roughly a third of our population, not counting government workers, are supporting everything. Okay, now the 69 million are children, and they can't work, but still, it's a big part of the people we have in our country. And 90 million are not included in the unemployment number. Okay, the 22 million over on the side, that's the number that they consider when they tell you the unemployment rate. They say people that are looking for work. So there are a lot of people that still are not looking for work. Any questions on that? I know there's a lot of stuff going on.
Million, is that retirees or what is that?
That would be people that can work but aren't looking.
Which includes who?
That would include, could be disabled, could be people that just, they're not looking. They move back home, they move in with, family groups coming back together. Mm-hmm. This shows what the labor force gains and losses have been over time. So since 2000, and there are included in here retirees too, as well, have departed the labor force. The net number is all the way over on the end. And then since 2009, we can see the net number that have departed. And then since 2010, we can see it's starting to reverse. So it's net job gains are what are happening there. Because the thing that, needs to be considered as well is, when we see more people being employed, like every year, people are graduating from college, people are graduating from high school, so people are entering the labor force. And then we have people retiring too, but there are a lot of people that are continuing to work. I mean, I don't know about you, but I go into Walmart and I see some very elderly people working in there. So there are people that are going back to work also. And actually the fastest growing population for people, for jobs is over 55. So it's interesting. So the housing. So of course that was a major contributor to the previous recession in so many ways. But we are seeing recovery, which is really encouraging. Really encouraging. So home prices are rising and new housing starts have been picking up. So that is really, really encouraging. And those numbers are they just are what they are. I was just looking at a statistic today where lumber prices, we're starting to see them start to go up, which is good because that typically means there's more demand for housing and for, so forth. But with the mortgage rates ticking up, new applications for mortgages for buying homes have been decreasing. Yeah.
It seems to me it's a two-edged sword, though, because for those of us that own houses and our equity goes up, that's great. But wages aren't going up, and young people with higher, how are they going to buy a? I don't understand how it's going to work itself out.
That's true.
I'm very confused.
Well, we've always been in that conundrum, though. I mean, if you think about it, when our parents sold their homes, there were a lot of us coming in buying homes. So a lot of them.
Wages were going up.
And wages were going up.
Way more than they are now.
Yeah,
That's
very
the
true.
difference.
Very, very true.
I can't figure out how it's going to work.
Yeah. Yeah, definitely true. So we can see housing starts have been, increasing, which is a good sign. Part of it, though, too, is, and when we talked about like consumer confidence and so forth, people feel more confident about the future. They'll tend to borrow money and buy a house and get into something long term because, even though housing prices are coming back, they're nowhere near where they were. And I don't know if we'll see that for a long, long, long time. Depending on where you are. Certain markets, they've held up pretty well, like in the city and stuff. But so this is just a cartoon here. We didn't really, officially we're not in a recession. I mean, Europe is, but not us. So So this was in June. It started in May, but really in June, when Federal Reserve Chief Ben Bernanke surprised investors by signaling, the economy is healthy enough to slow our quantitative easing program down that the government's been doing. And they're going to conclude sometime in 2014. Well, now they've come back and said, well, they might not even start tapering this year. They might not start till next year. So, what does that mean? Essentially, banks, their assets are loans. Okay? They loan you money and you pay them interest. That's an investment for them. They also invest in government bonds. So when the government buys those bonds back from the bank, it's giving them more cash so they can turn around and loan out. But it's harder to get loans now. It's harder. What people have to qualify for to get a loan is more difficult. So, we still have this conundrum going on here. But when he spoke in June, everything, the markets, bonds, mortgage rates went up. And so we've seen in the last 13 out of 15 weeks that mortgage applications are going down, week over week over week over week. So, there's a fine line there. But the Federal Reserve policy now, I always love this because it has not resulted in inflation, official inflation, but anybody that shops in a grocery store knows that prices keep going up and the boxes keep getting smaller.
Right.
So to me, that means inflation. But they take a lot of things into consideration, and the official inflation rate is not very high. So we can see the official inflation rate has been low. And interest rates have gone up. And investors preparing for a shift in Fed policy have stampeded out of some of the best performing assets. So that would be bonds and gold, which have been doing very well. So, okay, so where are we now? So we'll talk about the wealth effect and a little bit about our tale of two nations here in the U.S. and consumers gaining confidence, corporations, their lower expectations, some geopolitical tensions, and stocks trading just below all-time highs. So U.S. household hit our net worth. So net worth is our assets minus our liabilities. So you take whatever our assets are, subtract out our debt. Our net worth hit a new record high in the first quarter of 2013. So net worth of all U.S. households surpassed $70 trillion. So that was up 9.6% from the same time in 2012. Now this slide is looking at 2011, from 2009 to 2011. Despite net worth record, only the top 7% of Americans have regained their wealth. Okay, so it's not proportionate. Okay, I guess that's the point I'm trying to make here. So let me, so this video is a little long, but you could take it in a political way. It's not meant in that way at all. It's really not meant, to be against one party or for another party. It's just kind of looking at the inequality in America and how it's gone from, where it's come from and where it is now. And that speaks to kind of what you talked about, Guy, with, we're not getting the wage growth. So how are people going to afford it? What's happening to our middle class? People feeling the squeeze, and they are feeling it for a reason because they are being squeezed. Yeah, especially when we look at our children. Many of our children are, it's tough. Raising kids, paying for college, et cetera, et cetera. There's a lot to it.
There's a chart I saw recently that I can't get out of my head. A Harvard business professor and economist asked more than 5,000 Americans how they thought wealth was distributed in the United States. This is what they said they thought it was. Dividing the country into 5 rough groups of the top, bottom, and middle 3 20% groups, they asked people how they thought the wealth in this country was divided. Then he asked them what they thought was the ideal distribution. And 92%, that's at least 9 out of 10 of them, said it should be more like this. In other words, more equitable than they think it is. Now that fact is telling, admittedly, the notion that most Americans know that the system is already skewed unfairly. But what's most interesting to me is the reality compared to our perception. The ideal is as far removed from our perception of reality as the actual distribution is from what we think exists in this country. So ignore the ideal for a moment. Here's what we think it is again. And here is the actual distribution. Shockingly skewed. Not only do the bottom 20% and the next 20%, the bottom 40% of Americans barely have any of the wealth. I mean, it's hard to even see them on the chart. But the top 1% has more of the country's wealth than 9 out of 10 Americans believe the entire top 20% should have. Mind-blowing. But let's look at it another way, because I find this chart kind of difficult to wrap my head around. Instead, let's reduce the 311 million Americans to just a representative 100 people. Make it simple. Here they are: teachers, coaches, firefighters, construction workers, engineers, doctors, lawyers, some investment bankers, a CEO, maybe a celebrity or two. Now let's line them up according to their wealth. Poorest people on the left, wealthiest on the right, just a steady row of folks based on their net worth. We'll color code them like we did before based on which 20% quintile they fall into. Now let's reduce the total wealth of the United States, which was roughly $54 trillion in 2009, to this symbolic pile of cash. And let's distribute it among our 100 Americans. Well, here's socialism, all the wealth of the country distributed equally. We all know that won't work. We need to encourage people to work and work hard to achieve that good old American dream and keep our country moving forward. So, here's that ideal we asked everyone about. Something like this curve. This isn't too bad. We've got some incentive, as the wealthiest folks are now about 10 to 20 times better off than the poorest Americans. But hey, even the poor folks aren't actually poor, since the poverty line has stayed almost entirely off the chart. We have a super healthy middle class with a smooth transition into wealth. And yes, Republicans and Democrats alike chose this curve. 9 out of 10 people, 92%, said this was a nice, ideal distribution of America's wealth. But let's move on. This is what people think America's wealth distribution actually looks like. Not as equitable, clearly, but for me, even this still looks pretty great. Yes, the poorest 20 to 30% are starting to suffer quite a lot compared to the ideal, and the middle class is certainly struggling more than they were, while the rich and wealthy are making roughly 100 times that of the poorest Americans and about 10 times that of the still healthy middle class. Sadly, this isn't even close to the reality. Here is the actual distribution of wealth in America. The poorest Americans don't even register. They're down to pocket change, and the middle class is barely distinguishable from the poor. In fact, even the rich between the top 10 and 20 percentile are worse off. Only the top 10% are better off. And how much better off? So much better off that the top 2 to 5% are actually off the chart at this scale. And the top 1%, this guy, well, his stack of money stretches 10 times higher than we can show. Here's his stack of cash, restacked, all by itself. This is the top 1% we've been hearing so much about. So much green in his pockets that I have to give him a whole new column of his own, because he won't fit on my chart. 1% of America has 40% of all the nation's wealth. The bottom 80%, 8 out of every 10 people, or 80 out of these 100, only has 7% between them. And this has only gotten worse in the last 20 to 30 years. While the richest 1% take home almost a quarter of the national income today, in 1976 they took home only 9%, meaning their share of income has nearly tripled in the last 30 years. The top 1% own half the country's stocks, bonds, and mutual funds. The bottom 50% of Americans own only 0.5% of these investments, which means they aren't investing. They're just scraping by. I'm sure many of these wealthy people have worked very hard for their money. But do you really believe that the CEO is working 380 times harder than his average employee? Not his lowest paid employee, not the janitor, but the average earner in his company. The average worker needs to work more than a month to earn what the CEO makes in 1 hour. We certainly don't have to go all the way to socialism to find something that is fair for hardworking Americans. We don't even have to achieve what most of us consider might be ideal. All we need to do is wake up and realize that the reality in this country is not at all what we think it is.
Okay, so that's quite dramatic. And like I said, there's no political views, and we're certainly not advocating socialism, but just trying to get, an idea of what we're up against here.
You didn't advocate anything.
No, this is just to be aware. That's all. It's just awareness. So some interesting things, though, are that, those of us that are doing well, I consider myself in the top 1% by any means. So I don't think anybody here in the room is. But cars have been going up. Okay, we're seeing a lot of people buying cars, which is really good because it helps the manufacturing and the auto industry. And another is the art auctions are record-breaking, prices for artwork. Yeah. So, really, really going up. Yeah. Yeah. Things like cars. My husband loves to watch the car auction on TV and stuff, and, things like that. So money is being spent. So another thing that's going on is that corporations, what we've been seeing, I don't know if you pay much attention to it, but many times stocks are valued based on their earnings per share, and corporations give guidance. So they come out with their earnings, okay, and then they give guidance like, we think it's going to go up this much, in the next, year, 6 months, whatever. And then there are economists that work for a lot of the brokerage firms, the major banks, that say, we think this company's going to beat their estimate, or they're going to make it this or not make this. And what keeps happening is they keep getting lowered and lowered and lowered so that it becomes easier for them to beat the guidance. And this has been, a trend, actually. So corporations lowered guidance for second quarter 2013, and the ones that lowered, were 4-to-1 ratio versus the ones that raised their guidance. So, and then what we're seeing too is they're saying, like in 2014 and 2015, they'll do really well. Like things will really turn around. The economists are saying that, but they said that 2 years ago about this year, too. So it keeps getting pushed out. Got to give corporations credit. They have very healthy balance sheets, very healthy balance sheets, a lot of cash. So they're doing very well in managing their assets. And I think it's hard too, you think about it, last year we had a lot of political stuff going on, and a lot of companies didn't know what was going to happen. We had the health care law that was before the Supreme Court, whether that was going to be upheld or not. You had an election for the president. You had, the whole budget fiasco going on with Congress last year. So it's really hard for companies to plan, when there's so much up in the air. Like I said, the expectations remain that earnings growth will accelerate in 2014. But that's been the expectation. And what happens, they keep lowering it. So we'll see. Okay. I don't know if anybody's seen this. I saw this before. The lines in the sand. So this is Iran and Syria. We have some geopolitical risk. And I don't know if anybody saw, I'm sure you did, about Egypt today. A lot of terrible things going on, really troubling news there for sure. So there's always this geopolitical risk, and that's part of the reason why we have, and earlier I was talking about the bonds and the yields, the prices coming down and so forth, but if we have an event or something happen, we still own bonds because they still provide stability, income, et cetera, and especially if something were to occur that we just can't predict. So this goes back to, earlier this summer when the U.S. decided to send weapons to aid Syrian rebels. We can see President Putin and President Obama, not quite getting along there, by their body language. Not too happy about what's going on. So where we may be going. So we have the Fed exit, meaning they're going to stop supporting the economy, and what the impact will be on financial markets. And it's interesting. Has anybody ever watched a particular stock and they come out with their earnings and they beat their earnings and then the price goes down? yeah, it's like, okay, now, why did that happen? And it's the same thing with even big things like a Fed exit. Some people think it's going to affect things one way, and some people think it's going to affect it the other way. You just don't know for sure how it's going to affect things. China's economy is slowing. That's the second largest economy in the world. The European economy, which really is, when you take it all together, is the largest economy in the world. Money flows. Well, we see this rotation out of bonds into stocks, and then geopolitical risks. So the Federal Reserve is saying they believe the economy is strengthening, and if they're right, will interest rates continue to rise? And can consumer spending hold up as borrowing costs rise? So we saw mortgage rates went up really quickly in June. You see that last spike up there. That was in mid-June. It's come back a little bit, from there. So this graph shows the difference. So just for an example, a $225,000 mortgage going from 4% to 5%, the payments would go up about $130 a month. Now, that seems doable. That could be a factor for someone whether they can make it or not, but that seems fairly doable. But then when we go up to like 6% from 4, that's over 200, and then we get up to 7, that's almost 400. So it behooves the government to not. The reason I'm showing this is they're not going to slit their own throats. I know we all have our opinions about government and so forth, but they will taper. Taper means slowly pulling back, not just cutting it off, and causing interest rates to spike up, considerably. That's already happened, just based on what Bernanke said. So China's economy. So they're still in the midst of a transforming economy. I don't know if anybody's seen on different shows how they built all these buildings that were empty and so forth. Well, they're doing a social reengineering of a huge magnitude there. I mean, they're wiping out villages and moving people into cities. Imagine, okay, you pack up your stuff, you're, closing down, you're moving, this is where you're going. So that's what they're trying to do. So they're kind of doing what we did naturally, back in the time when we were an agricultural society, and then we had factories and people left the farms and went and, lived in cities, worked in factories and so forth, just for a better life and so forth, more opportunity, or maybe to avoid, weather issues or whatever, with farming life. But China is, making that happen for their people. So there's going to be less construction and other investment-related growth. They want to have their own consumer spending be the majority of their economy instead of relying on exports. And it's a slow transition. So we're seeing, when you look at the graph, their growth, they're looking for mid 7.5%, like 7.5% is what they want, the government there. Being a communist government, they can make it happen the way they want it. So even that's very good growth, but it's a lot slower than it had been, for sure. And it affects a lot of countries that have been supplying them with various things or buying the merchandise, So, but they're, China's it's doing okay though. They just had some good numbers that came out this week. And the Shanghai Composite Index, we can see that's had a rough year, okay, up through June 24th there. But now it's back up to 2,100 actually. So it's come back since then. It's not back to where it was, at the beginning of the year. So it's still down. And then the European economy. So we can see the countries that are growing between 2 and 3.9% are some of the Eastern European countries. And then we still have negative growth in Spain, Italy, and Portugal. Actually, Portugal just today, their second quarter, they had growth, a positive growth number, which is really positive. And Spain and Italy, their declines have lessened, so they're not declining as fast. And Germany, the Eurozone in general was up 0.3%. So it's like turning in the right direction. It's not a big change like a number, but at least it's improving. So Germany and France actually surprised with some nice, better growth numbers. And growth does remain absent in some of the areas. The one thing that I find troubling is the unemployment rate. There, the average is 12.2%, but when you look at the youth, gosh, that's troubling. Things like that happened like pre-World War II in Germany, where you had high youth unemployment. I mean, we're not in that kind of an environment, obviously, but things are starting to turn there. It looks like things are turning. And the European Central Bank does offer a backstop. mean, if you remember a couple years ago, you know, we're hearing stories about Greece and everything's going crazy, and we're not hearing about that anymore. It's very quiet because when they have troubles, they just take care of it. It doesn't make the big news, and they just, you know, they take care of it. They're not threatening to, you know, pull out. So then the Great Rotation, massive outflow from bonds back into stocks. So we can see, this is showing from 2007, the blue line is bond funds, how much money was flowing in. You can see just more and more and more was going in. And equities is the green line, so less was going in. Money was coming out over the time frame between 2007 and 2013. And money market funds, you know, the peak was in 2009, you know, when the market was at its low. And what this shows, if you just see those two lines on the bottom that go down way far there, these are weeks, you know, periods from 2012 to 2013. That was an outflow of money out of bond funds, big outflows in June. But they didn't necessarily go in the equity markets. They're sitting in cash. Is really where the money went. So we'll see what's going to happen with Syria, Iraq, you know, that whole business going on there. No ideas. But it's still a lot of things happening there that are troubling. Hopefully there won't be any, you know, big military conflicts. Tensions with China and Russia. At this time, they were higher than any time in recent history. That, you know, that tends to go down again, you know, and then tensions go up. So, but there definitely are risks out there, geopolitical risks too. You know, but I think personally, we're going to see more economic type of wars as opposed to military wars. You know, and same thing with cyber wars and things like that. I think those kinds of things are going on much more so than, and will be more so than an actual, you know, physical war. So that last video was so depressing. I've got one that's going to be leave us on a light note here. The message is to remember to laugh. It's really good for you. We watch the news and everything, we get very depressed, but, you know, there's a lot of good things going on. Even when I was showing the unemployment numbers, you know, think about the opposite of that. You know, 12% of people are unemployed. That means 88% of people are employed. Right?
This one, Micah. Look at this one.
Yeah. If only life were so simple, huh? Yeah. So that's the end of our presentation. Does anybody have, I know we answered some questions as we were going along. Any other questions? Yes? The question has to do with what would it be like if more things were manufactured in this country like they were many years ago. Actually, we are starting to see a resurgence of manufacturing in this country, even to the point where some factories are, because if we talk about China, but literally, big companies, they'll move. They have factories built in China, they will move from China wherever the labor is cheaper. And as energy costs, as we're producing more of our own energy and so forth, companies, manufacturers are building their own electricity producing from natural gas plants next to a factory here, because then they don't have to transport it back and forth. Manufacturing is starting to come back. Now, will it come back to that extent? That I don't know. And because, you know, we're in a free country, we can't force businesses to, you know, keep them here. I mean, that's what Japan did, and Japan got themselves in quite a bit of trouble because they couldn't move with the competition and so forth. But I think businesses can definitely, be incented to keep the jobs here. I definitely would agree with that. Any other questions? No? Well, there's some evaluations. Please fill them out. And thank you, everyone, for coming. It was wonderful to have you here. I hope you enjoyed listening to Melissa Motz. And if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motz, that's M-O-T-Z, wealthmanagement.com for the most up-to-date listing of these events. Over the years, many of my clients have asked me to speak with a friend, relative, or colleague concerning private financial management. I consider it an honor and a privilege, and have been happy to accommodate those wishes. For your future reference, I want you to be aware of the standards by which I comply with such requests. First, confidentiality is the cornerstone of my business. Each of my client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, I will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send me an email at Melissa, that's M-E-L-I-S-S-A, at motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.